This podcast is solely for the attention of institutional, professional, qualified, or sophisticated investors and distributors.
Hello everybody. Since 2015 and the passing of its law on the energy transition and green growth, the famous Article 173, France has gradually built up its legislative arsenal. In 2019, Article 29 stipulated in particular the need to quantitatively assess climate risks. To address this need, the French Prudential Supervision and Resolution Authority, ACPR, in 2021 launched its pilot exercise on climate stresses. At CPR Asset Management, we are well aware that climate is at the heart of our clients' concerns. That's why we continue to review environmental issues in order to offer the solutions that are best suited to investors' needs. Let's start with a background on ACPR pilot program on climate stresses. The voluntary program pursues a dual objective. First, to encourage banks and insurance companies to assess the climate change risks and vulnerabilities that they are exposed to. Second, to identify their current shortcomings in terms of tools, indicators, data, and resources, so they are able to reiterate this exercise on a recurring basis. Climate risks are long-term in nature and lack a track record. They therefore require a stress test methodology that is particularly innovative in various ways. The 30-year time horizon, which is essential for incorporating climate change impact, but this is very unusual duration for stress tests. The nature of the stress test, based not on historical data but on a prospective data series. The shifting composition of the assessment. It will remain static until 2025 before becoming dynamic from 2025 to 2050 in order to analyze financial institution strategies and what they have done to mitigate the effect of climate change. One of the keys to the exercise is defining the scenarios. The ACPR based itself on those published in June 2020 by the Network for Greening the Financial System, NGFS, and chose 3 for transition risks and 1 for physical risks. The first one, called orderly transition, is the base case scenario, which is close to the national low carbon strategy. It targets zero net emission by 2050. The second, called postponed transition, the greenhouse gas reduction target is not reached by 2030, which requires a rapid increase in carbon and energy prices. The last one, called accelerated transition, an even greater increase in the carbon price, triggering a shock to productivity as early as 2025. The physical risk scenario, meanwhile, is based on the IPCC's scenario and assumes a temperature rise between 1.4 and 2.6 degrees Celsius by the end of the century. These scenarios are then fed into prediction on macroeconomic and financial variables, with a fine granularity in terms of geographical regions, economic sectors, and asset classes. It is this correspondence between scenarios and the financial valuations of assets that allows us to measure portfolios' resilience. Let's study the findings of ACPR's pilot exercise on climate stresses. The qualitative call has been met in full. The fact that the sector has already so much is proof that the issue's importance is now understood by various organizations that are willing to bring to bear the human and material resources to address it to the utmost. The quantitative call has had a reassuring impact. as it is moderated for participants' transition risks, but it has also revealed a number of limitations. The highly controversial choice of taking the national low-carbon scenario as the base case scenario. A level of granularity that is not always sufficiently detailed to difference between companies in the same sector or having businesses in prior sectors. Among other things, this is rather incompatible with CPR asset management's approach, consisting in selecting the companies that are most advanced in managing climate risk in each sector. None of the scenarios assume an economic recession between now and 2050. Little variability between the various scenarios developed, which has resulted in only a slight differentiation between results, with the exception of the effects on the most affected sectors. In light of the above, as things now stand, while climate risk has been clearly identified as a major risk requiring action from companies, its extent, as calculated in this exercise, is not incentive enough to encourage companies to adjust their investments to limit its impact.
All comments and analysis reflect CPR AM views on market conditions and its evolution, according to information known at the time. As a result of the simplified nature of the information contained in this document, that information is necessarily partial and incomplete.